The government of Canada recently made some groundbreaking changes to home ownership and more specifically to mortgage requirements for Canadians, which they described as the boldest mortgage reforms in decades. The timing of these changes have also been heavily scrutinized as a political ploy, but I'll leave that for you to decide. Now, we will get right into it. The changes that were recently implemented include an increase in the price cap for insured mortgages from $1 million to $1.5 million. When you're shopping for a home and you're looking at buying a product for $1 million plus, you would have had to get a conventional mortgage and put at least 20% down on the entire purchase price until now, of course. The other change was to expand the eligibility for 30-year amortizations to all first-time homebuyers and to everybody purchasing a new build, regardless if you're a first-time homebuyer or not. This policy was also implemented in August of this year and has now already been changed or revised. Beforehand, the 30-year AM rule was strictly for first-time homebuyers of new builds, and that's it. It didn't extend to the resale product until now. Are these changes good for Canadians? I honestly think that they're good and bad, which I'll go over. If you want to buy a home with a down payment of less than 20% in the Canadian real estate market, you would need something called mortgage loan insurance. And why is this in place? For the consumer, this lets you get a mortgage for up to 95% of the purchase price while helping ensure that you get a competitive interest rate, even if you do have a smaller down payment. Banks and institutions lending you this money will have this requirement in place in the event that you can't fulfill your obligation to make your monthly payment. Your lender will pay an insurance premium on the mortgage loan insurance, which is then passed on to the purchaser of the home, aka you. You can make a payment in lump sum or add it to your mortgage and include it in your month-to-month payments. Increasing the amount from $1 million to $1.5 million will definitely help those in Canada's more expensive areas like Toronto and Vancouver to stay in their local markets. The average price of a detached home sat at $1.692 million in August 2024. This number is up 36% compared to 2018 at the same exact time, which isn't that long ago. Extending the amortization for an extra 5 years will make monthly carrying costs cheaper, which is a good thing. It's estimated that consumers would see a relief of around $300 per month based on the average Canadian home price, but you are going to be paying much more in interest over the lifetime of the mortgage if you follow the regular payment schedule. Obviously, you can find a home for less than this price tag in certain areas throughout the city, but with the average this high, so many people in the city were forced to buy a condo if they wanted to stay local due to current mortgage requirements, which then can be viewed as a bad thing if you're only looking at this from a financial standpoint and are disregarding one of the key aspects of home ownership, which is to have stability for you and your family. So from a bird's eye view, both routes will cause you to pay more money in interest over the lifetime of the mortgage if you're sticking to the minimum down payment guidelines. But if you're someone who does well income wise, or if you're buying with a partner, you can pay down your mortgage quicker by making lump sum payments every year or every couple of years. And this money goes straight towards the principal portion of the mortgage. So now you can see how there's a little bit of good and a little bit of bad with the scenario at play here. As for where we're at right now, interest rates have been coming down over the last couple of months and inflation is finally sitting at the 2% mark, which was exactly where the Bank of Canada wanted to see it, and it's at the lowest point it's been since February 2021. Economists have also predicted that the overnight lending rate will be in between 3 to 3.5% by the end of 2025, with some banks even expecting it to be in the 2s. But with these new policies taking effect on December 15th, 2024, will it spur activity in the real estate market a little too quickly and then force us to have to react to the cuts that we've already made? This is a question that I have, and to me it really does seem like it's an idea that was put in place to push the market forward and to drive up home sales. And I want to add that as a result, it may not happen right away, but with more people out there having the confidence to get into the market and in an even easier fashion than before, that could very well make properties more expensive in the long run. There you have it. Those are the latest details in the Canadian housing market. My name is Trey, and thank you so much for watching, especially if you've made it this far. We'll see you later.